The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Alex Steele. Romaine Bostick is off for the day. What a day it was. Powell did not disappoint.
No, he didn't. He delivered.
He delivered. Let's check it here on where markets stand. I wanted to bring an intraday chart of the S&P just to show the momentum of the rally within the equity market. So you wind up seeing this big move here. The timing is weird. Okay. A big move up here, which is when you had Powell's speech, and then we kind of dipped to the session low, and then we kept moving along here. But we're not at the session highs, but we are still holding strong, up by about 0.8%. Another rally on the week as well. It was definitely a buy bonds, buy stocks, sell the dollar kind of story, Scarlett.
Yeah, and the message was clear, right? The time has come, says Fed Chair Jay Powell, making clear the central bank is ready to start interest rate cuts next month. But he is not at all clear on the timing and the pace of these cuts.
And the S&P rally is led by cyclical stocks. Small caps outperform and bond yields fall. You also have the dollar sinking now the most since November. We are going to break down those market moves for you and set you up for the next market event,
which is the tail end of earnings. Expectations heading into NVIDIA's results next week are pretty high, with the chipmaker forecast to report a doubling in sales and EPS for a fifth straight quarter. Speaking of companies whose shares are up more than 150% this year, the CEO of Cava will be stopping by to discuss their blockbuster results. But the major story of the day, of course, continues to be that Powell pivot earlier this morning. Take a listen.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks.
Let's kick things off with Earl Davis. He is head of fixed income and money markets with BMO Global Asset Management. Earl, what was your take on Powell's remarks, especially given the positioning that we saw yesterday heading into these comments today?
Yeah, unequivocally dovish. And I don't think that was too much of a surprise to the market in regards to confirming the data that we've seen. But the importance of today's number is that it turns the full focus to employment. Inflation is no longer in the crosshairs, at least from a short to medium term. It is fully on inflation. So I think that makes it easier to judge where rates will go going forward.
What he didn't say, though, were the words like methodical or gradual when it came to cuts. Does that mean to you the door's open for 50 in September?
Yeah, it definitely does. And it all depends on one thing. That's the unemployment rate. So the way we are looking at it, we added to risk today, duration, but we're 50% of our max risk. The way we're looking at it, our base case right now at 4.3% unemployment is 25 basis point eases going forward. As soon as we hit 4.5 to 4.5 and in between 5, it moves to 50 basis points. Not necessarily every meeting, but the next meeting after we see a 4.5 rate will be 50 and maybe intermittently the 25, 50, 25. If we go above 5%, then it's 50 basis points hikes. And the target right now is 3% in our eyes. Unless we have some recessionary fears, then it could go below that.
Okay, you say the key data point will be the jobs report, and that is on September 6th. That's still another 2 weeks from now. So what are investors going to do from now until then? What are traders going to do from now until then?
That's a great point. So I heard you say earlier, someone say slow to low. We do believe it's a grind lower, but it's not slow to low. What will happen in between now and the unemployment reports is volatility. That was our highest conviction view for 2024, and it's played out and will continue to play out. The volatility will come from the election, basically. So on spikes higher towards higher rates, we think as 10-year yields spike towards 4% provides a great buying opportunity, as we do believe it is grind towards lower rates from here.
So Earl heard me talk during the break because I kept talking about, we're going from higher for longer to slower to lower.
That's what she was saying, and I was talking about Deadpool. So I think that just perfectly encapsulates Scarlett and myself. So Earl, if I take a look then at the 2-year, 3.9%, clearly the market is going to be buying all across the curve. I was mentioning earlier that was severe weakness there in the dollar over the last 5 weeks. Is that all justified? Does this all make sense to you?
It does. Maybe it got a little bit ahead of itself in regards to discounting 100 basis points, but it doesn't mean that all of the discounting is done. This is the reason why you'll get slow to low, because of how much is discounted in the market. But a key thing to remember, you heard Hawker this morning in regards to saying neutral is 3%. That means they could ease rates from 5.30 to 3% without being in an easy state. So from our perspective, we actually prefer being long 10 years and 30 years. We think there's less volatility on being long there, and we like that it's above inflation and above the neutral rate. But nonetheless, this applies for the whole curve in regards 3% just gets you to neutral. If anything happens, a significant extended risk off, unemployment goes above 5%, you could easily go below 3%. And I think it speaks to where the Fed put could go as well. So here, I wouldn't be all in risk, which is why we're not, but we have a significant amount of risk in regards to half our max risk position.
What about on the corporate credit side? Do you expect a flood of issuances now that Powell has made clear it's a go in September?
I wouldn't say a flood because it will be the slow to low, as you put it. So because of that, you could issue as you would expect. Having said that, we do expect issuance to be robust, given where rates were over the past 2 years. And we do expect, and we do like credit overall. Having said that, we are reducing our credit positions at this level just because of the valuations, but we're staying long. And the reason why we like credit, this definitive statement about eases are next says, you know what, no matter what happens with the economy, they're going to try to prolong the great state. That is good for corporate credit.
Yeah.
It pushes forward the default cycle. Yeah.
Sure. And also just, help that soft landing scenario, which they seem to be at the moment pulling it off. So before we let you go, and we take a look then, you're mentioning how the jobs data then becomes all that more important and how that's going to be the Fed's focus. What should the market reactions function now be to that data? Is this going to be a redux of what we saw early August?
That's a great question. So how we're positioning ahead of that data, if we do get a stronger than expected data, as I mentioned, towards 4%, we will be buyers. However, if similar to the last data point where we got this 20 basis point move, we will reduce our long duration position. The reason is not because we don't believe in lower rates, but we highly believe in volatility. And the reason why we're having volatility is that there's so many credible, probable outcomes on both sides of the equations. So there's a way to monetize that, and we're positioning ourselves to monetize that.
All right, good stuff. Earl, really appreciate your joining us on this Friday. Earl Davis is head of fixed income and money markets with BMO Global Asset Management. Now, coming up on the close, shares of Cava sizzling right now, gaining 22% after the fast casual chain's latest results. The CEO joins us next to dive deeper into Cava's numbers.
All right, we're also watching some major gains here from Warby Parker and Roku after both stocks got analyst upgrades this morning. We're going to discuss their potential investment.
And we're headed out west to cowboy country. Just hours after Powell's policy shift speech, Bloomberg's Michael McKee sits down with the former president and CEO of the Kansas City Fed, Esther George. All that and more coming up. This is The Close on Bloomberg.
One company we're keeping an eye on today is Cava. So shares of the fast casual chain are up about 20% after posting second quarter results that beat Wall Street estimates. Cava's CEO, Brett Schulman, joins us now. First of all, Brett, it's great to have a CEO here on a Friday afternoon. We really appreciate it. Who are you guys stealing market share from?
Well, we talked about our value proposition that's resonating with consumers. And when you think about the challenge of the traditional chain full-service dining model to deliver a compelling value proposition in the post-pandemic, post-high inflationary environment, or you think about traditional fast food below us that's had significant price increases at a faster rate than us. From the end of 19 to the end of 2023, we raised price about 12% during that time period. CPI grew about 18%. The Department of Labor has noted that fast food has raised prices upwards of 30%. So that's magnified our relative value proposition. So what we're seeing is folks trading down from full service, trading up from traditional fast food, and even trading over from legacy fast casual players.
So it sounds like you're taking share from everyone.
Yeah, exactly.
We're gaining market share, and I think our unique differentiated Mediterranean cuisine is another way we're resonating with guests, that unique cuisine where taste and health unite. You know, the modern consumer, they want flavorful, satisfying food, but they want their health too. And that's where our food comes in, and they don't have to make those compromises.
You've also added grilled steak to the menu, which you say has significantly outperformed your expectations. Does grilled steak mean more male diners? Because I know Sweetgreen added grilled steak, and part of that was to get more men through the doors.
Yeah, traditionally we've been about 50-50 male-female from a gender mix. And so we've also been 46% of our occasions at dinner. We cook with fire, we roast, we grill, we braise. So grilled steak is a natural fit for our menu. And what we're seeing is it's resonating with all of our customers. It's bringing in new customers, and it's resonating with existing customers who are coming back more frequently.
And where do you see the most growth in either income or age right now?
We're seeing it across the board. We noted this on our call. We're seeing strong comps across all income segments, across restaurants in all areas of the country. So really broad-based strength across the brand.
And you're expanding your footprint as well. I understand you're now adding 54 to 57 restaurants. That's up from 50 to 54. What specifically is driving this faster pace? Is it the hybrid work trend? Is it expectations of lower rates? I mean, something macro like that? Or is it something more specific in terms of where you're currently located?
Well, our goal is to grow to 1,000 restaurants by 2032. That's about a 15% plus compound annual unit growth rate. But our development team and our real estate team have done an exceptional job this year, really building a robust pipeline and able to open restaurants on time and in some cases ahead of time. So that's allowed us to exceed that projected growth rate for the current quarter.
Based on the fact that you're kind of stealing market share from everybody, is it strategic where you put a store? Like, do you want to be close to traditional fast food? Do you want to be close to a traditional competitor? Do you want to be close to fine dining? Like, how do you look at it?
We want to be where our guests want our food. And what we're finding is that's a lot of places, whether it's in the city, whether it's in the suburbs, whether it's in small towns, whether it's in Back Bay in Boston or Bryant Park here in New York or Fayetteville in North Carolina or Fayetteville in Arkansas. And I think that's what gets us excited, the broad appeal of our cuisine. It works and meets the needs of so many diverse consumers in so many different parts of the country.
Broad appeal of your cuisine, yet do you make adjustments for local preferences, for a restaurant in, say, New York versus, say, in Texas?
We see pretty consistent menu mix across the country. Certainly a little bit more beef consumption in Texas and a little bit more plant-based out in California, but it's really fairly consistent in all of our restaurants across the country.
Going to something you guys talked about on the call in terms of the same-store sales, and for this year, you're still looking for that to rise about 9.5%. Some analysts talked about that as being conservative. What would you need to see to upgrade that forecast?
Well, we feel really good about the momentum and strength of the business today, and it does imply low double-digit comps for the remainder of the year. What we also wanted to incorporate in those projections was the macroeconomic uncertainty that we're seeing across many industries today, as well as the upcoming election uncertainty in November.
But does that mean that if you get clarity on you're going to upgrade your sales if you get clarity on the election? Like, what's the tie-in?
Well, just knowing the uncertainty, people tend to peel back sometimes on spending until they know what the future is truly going to look like.
Well, when people peel back from spending, generally, if you're a retailer, for instance, you adjust your inventory to account for that because you don't want to overorder and end up with too many things that you then have to mark down to move product. What does that inventory management look like at restaurants? Is Cava streamlining and managing inventory in a different way?
Well, for us, we're fortunate that we're delivering fresh food. So that's pretty real-time inventory as we're harvesting fresh crops and bringing that through the supply chain. So we don't see really any impact on that end.
How do you manage all the inflationary impulses?
Well, I think that's been a strength of our brand and the power of our unit economic model. If you think about it, year over year, we've increased wages 9%, investing in our team. We like to invest in our team, invest in our guests. That creates long-term shareholder value. We've also tried to mitigate price increases, invest in our guests. We talked about only that 12% price increase from 2019 to 23. Another example, in California, we did not take any incremental price. I believe we were the only limited service chain that did not take incremental price as a result of the legislation AB 1228 that required wage increases in the state of California. So we don't see those price increases, only about 3% across the chain that we took in January. And that's really delivered a compelling value proposition to our guests. And then at the same time, we've grown restaurant level margin. So that's been the power of the model. As we've driven sales, we've driven traffic, we've gotten that flow through, and it allows us to then reinvest in the business and reinvest in our guests.
What kind of loyalty programs do you have to make sure that you hold on to these new customers that you've taken from your competitors and from lower price chains and the fine dining restaurants?
Well, that's something we're excited about. We talked on the earnings call. We've had the same loyalty program for over a decade. We're very excited to finally be able to relaunch that program in October. And it's what we call an earn and bank points model, where you'll be able to bank up points and then redeem those points for a variety of reward redemptions, a catalog of options for different menu items like your favorite craveable pita chips. You can redeem those points for.
I'm looking at it right now, 100%. Real quick, hiring? Are you doing any of that? Where do you feel the labor market is for you?
Yes, we are hiring. We're, as we talked about, we're opening 54 to 57 new restaurants. That's 54 to 57 new general managers, new team members in every one of those restaurants. We do have a great internal promotion rate. Last year, we placed 75% of our new GMs internally. And then I would note also that our turnover rate year over year is down 28%. So not only are we hiring folks, we're able to retain them and develop them and hopefully promote them into those new general manager roles to open our restaurants.
Brett Schulman, it's been a pleasure. Please come back again.
Thanks for having me.
Brett is CEO of Cava.
All right, coming up, you got Roku riding high after an upgrade from Guggenheim, and the analyst says it is the stock to watch. We'll get it next in our top calls. This is The Close on Bloomberg.
It's time now for our top calls to look at some of the big movers on the back of analyst recommendations. And first up is the pet goods retailer Chewy fetching an upgrade to overweight from neutral over at Piper Sandler. The analyst says top-line trends are likely still muted, but Chewy appears to be at a profitability inflection point thanks to gross margin expansion and well-managed discounting practices. The price target barks up to $35 from $22 and the stock up almost 3%. Next in line is Topgolf Callaway stuck in the rough with a double downgrade to underperform from outperform over at Raymond James. The firm being driven away by weak sales at its namesake chain of high-tech golf ranges. Analysts also fear the potential spinoff of the Topgolf chain comes, quote, too late to turn the tide. Shares down 1.25%. And finally, Roku. Guggenheim clicking up to buy from neutral. The analyst Michael Morris saying the company is closing the gap between platform engagement and advertising sales growth. He's also encouraged by the company's profile and valuation, which he believes are underappreciated. Price target of $75. The share is currently at $69.39, up 12%. And those are some of our top calls.
All right, let's dive deeper now into that last call on Roku with the analyst behind it. Joining us now, Michael Morris, Senior Managing Director at Guggenheim Securities. All right, Michael, walk us through the potential upside here for Roku, why you see it and what the timeline is for it.
Sure. So I think you have to take a step back and look at this connected TV streaming industry, which many of us know is a very robust industry. It has a lot of secular growth. You're seeing a lot of individuals spend time with streaming at growing rates. That usage has been growing much more quickly than the monetization of the platforms, especially advertising-based monetization. Roku is one of these platforms that has very much enjoyed a leadership position on the utilization side, but that utilization has grown much more quickly than their advertising revenue has. And we've been somewhat critical of the company over the last couple of years and kind of lagging the industry or maybe not taking as assertive of steps as we thought were possible. But right now, we feel like we're getting close to something of an inflection point for the company. They've made some great advances with respect to starting to open their advertising inventory to third-party partners who will help them monetize. They've made some upgrades to their display, right, the home screen that consumers see when they come to the platform. And we think that those innovations are going to be part of an accelerating revenue cycle that will start as we close out 2024 and move into 2025. But we should get early indications this quarter, and that's why we're enthusiastic about it right now.
Okay, so you talk about these changes and how it'll accelerate revenue. Is it something that will interfere or get in the way or be immediately noticeable to viewers in a way where they might react poorly to it? Or is it just kind of going to be something that gets folded in and they'll just go on moving along thinking, oh, this is very organic?
Yeah, it's a very fair question because when we talk about monetizing user behavior through advertising, we always have that concern about interrupting their experience, right? I think this is one of those unique cases where this will not be incrementally interruptive to their experience. So as it stands right now, video viewing, television viewing has a certain amount of advertising in the content that is interruptive, but most people understand it compensates for their entertainment experience. And those ad loads on connected TV have been much lower than the ad loads on traditional TV. So I think that there's always some risk, but there's a certain tolerance in there.
What about yeah, sorry, go ahead, Michael.
I was just going to say, in this specific example, though, Roku has had these sort of ad interruptions, and they just haven't monetized them that well. They've grown their viewership so fast. In the last quarter, they grew viewership on their Roku channel by 75%. And they're really only growing the monetization in the, call it, low double-digit range. So I don't think this will be, incrementally degrade the consumer experience.
Michael, who are its pure play competitors, right? Like Apple has Apple TV, then you got Walmart with Vizio. Like Roku seems the only one that you can go and buy as an investor for a pure play into this market. Is that true?
It is true. They are the standalone pure play. Think of them similarly to the way we talk about Spotify as a streaming music service or Netflix as a streaming video service. Roku holds a unique position. Think of Roku as that operating system, that on-ramp when you turn on the TV that has the apps, that provides the connectivity, and to a certain extent now provides its own unique viewership experience. The Roku channel, which I referenced before, is a tile you can click on, you can move into that experience, and it's the third most viewed tile on the platform. So within that, they have inventory, and now it's really a matter of doing a better job of selling that great audience that they've been able to aggregate.
I'm so glad you mentioned the Roku channel because that's where it does feature original content. And I remember when Roku first said it was going to start creating its own content, everyone was thrown by surprise. They were kind of like, wait, what? Has that paid off in terms of the amount that it's spending and the return on that investment?
The short answer is no, it has not. I would argue nothing ventured, nothing gained. It was not a significant or major investment for the company on some of the things that they've done. And some of the things are yet to be determined. They made a recent investment in Major League Baseball, the ability to show one exclusive game a week. And I think it's far too early to pass judgment on whether that has worked or not for the platform. But we have been critics over time of this integration between platforms and content, whether you see it in traditional cable television or other areas where you've had some of these companies try to put their channels and their distribution together. It simply doesn't work because in order for content to really flourish, it needs some pretty broad distribution in most cases. So we were very bullish on that strategy for Roku. And I really think that Roku's value is in helping consumers cut through the clutter of all this content that's out there, and the Roku channel does a great job of doing that. They don't need original content; they just need great content, and then help through the service.
All right, Michael, appreciate it. Thanks very much, Michael Morris of Guggenheim Securities, joining us on his Roku call. All right, coming up, we have been speaking with Fed officials all day in Jackson Hole, Wyoming. Some of the biggest takeaways from their remarks and how investors then feel about consumer confidence. This is The Close on Bloomberg.
Employment rates have gone from about 3.4% to 4.3%. That's a big change. Now, it's from super hot to solid, right? So I don't want to make it seem like labor markets are weak. But it really starts to tell me that things are much more imbalanced than they have been for quite some time.
One thing I heard is 25, 50, that doesn't matter so much as commit to a process. What I've heard, particularly from the bankers, is they need time to absorb the changes. So don't just stop and start.
It's just about 3:30 in New York. This is the Countdown to the Close. I'm Scarlett Fu.
And I'm Alex Steele. So those are a bunch of Fed officials who are speaking in Jackson Hole, Wyoming. And it definitely feels like it's still not a done deal. Jay Powell said something very specific. It felt that, okay, he's going to pave the way for the cuts. He didn't talk about moderate or gradual, which raised the 50 basis points. But others that we've spoken to have still highlighted the risk of upside of inflation and wanting to see more data.
And so that raises a question, even if you do price in a 25 basis point cut in September, which the markets have, what follows that? Nobody knows.
Right. And how does it actually then affect equity markets and sentiment? And luckily, we have Joanne W. She was the principal economist with Fed Research and Statistics Division. She also is now the director of the Surveys of Consumers at the University of Michigan. That the Fed actually does look at this data, particularly the inflation expectation data. Joanne, do you think your data changes if we get a 50 or 25 basis point cut?
Consumers aren't necessarily going to change their expectations over inflation that strongly in relation to rate cuts. Consumers have recognized that inflation has slowed considerably over the last 2 years. We see that in their inflation expectations, and they have been showing, quite a bit of stability in inflation expectations over the last several months. Consumers are fully expecting the Fed to reduce interest rates going forward, and they expect that to stabilize labor markets.
I have a question about consumers answering questions about inflation expectations. I was never quite clear on this. When they answer that question on where they see inflation, are they thinking in terms of their salaries, what they get to take in, or are they thinking about their spending?
They're really thinking about prices in general. There's been a lot of research trying to dig into how consumers are answering these questions on inflation expectations. We have other specific questions about income growth, about labor market strength, and these questions about inflation expectations, consumers really are focusing on prices in general. There are some elements of prices in general that are going to be more salient than others. As an example, gas prices are visible, are they're price tags that are visible from the street. Doesn't matter if you're driving or not. And so that does matter for consumers, but they are incorporating prices in general for this.
So, Joanne, what we've seen from the Fed is that the balance of risk has now shifted to higher unemployment versus higher inflation. And I'm wondering if that balance of risk has also shifted within those that you survey.
So consumers still tell us that, again, inflation is coming down and they recognize that. However, high prices are still weighing down personal finances, and it still remains a top priority for consumers. Consumers broadly recognize that labor markets remain quite strong. They are telling us that they're hearing a lot more negative news about labor markets. But at the same time, when we ask them specifically about unemployment rates or their own expected incomes in the next year, those actually look quite stable. And I think the reason for that is that consumers really do believe that the Fed is going to step in to make sure that labor markets do not deteriorate.
I got to wonder also, with all the developments taking place around the election, you just had the DNC wrap things up in Chicago last night, getting one side of the country very, very excited, just a few weeks after Republicans were very excited after their own convention. How does that show up in your surveys, and how does that show up specifically in confidence and sentiment across different regions?
A partisan split has been visible in our data for decades now. Consumers who belong to the party that's in the White House tend to have higher levels of sentiment than consumers whose person is not in the White House. So that is nothing new. What's really interesting about the month of August is that we saw a surge in expectations specifically for Democrats, following Kamala Harris becoming the new presidential nominee for the Democrats. And for Republicans, in contrast, their sentiment and expectations both deteriorated. Independents were in the middle. They rose a little bit. And so overall, those things evened out to an inching up of sentiment and expectations this month overall.
So what's your best guess, Joanne, then, knowing that we're going to have the uncertainty around the election, but knowing that those that you survey are much more worried continually about higher prices and especially food inflation and not the labor market, and then the Fed winds up cutting. How do you think that's going to change or affect sentiment at all?
Well, I think that for consumers, those are kind of two different things. What's going on in terms of prices at the pump, prices at the store versus the outcome of the election. A lot of consumers believe that the trajectory of the economy over the next year and the next 5 years is going to really depend on who is ultimately in the White House. And they are folding in those election expectations into their responses in our survey right now. It's still very early, I suppose, in the campaign season, given that we just had a change in the candidates. So as the campaign and the election season takes greater shape and comes into greater focus, I think consumers are going to may adjust their expectations in response to that.
Yeah, maybe need to start doing weekly surveys at this point, given all the changes that are taking place across politics. Joanne, thank you so much. Joanne Shu is Director of the Surveys of Consumers at the University of Michigan. I've always wondered about how you would answer a question about inflation expectations, because it's all based on what you just paid for. And, when I go to the supermarket or Costco, it's like hundreds of dollars every time. So, of course, I think inflation is going to keep going up.
Is that when you buy the really big things of something,
shampoo
that
or body
Jergens
wash.
that you
Yes.
put on your face that makes me sad. But I do think it's interesting that when you take a look at how expectations have fared, it's like through her data, you look at what they think is going to happen, they feel negative, but oftentimes their current expectations are fine, which goes to the whole idea of like everything's fine for me, but I'm still worried about you, or I'm worried about later on in the year or next year. And how do you kind of square that too as you're an investor or a Fed official?
Yeah, I just need to worry, in other words.
Yes,
right?
As we know, we do that sometimes.
Coming up, you don't need glasses to see Warby Parker's massive gains today.
I do need glasses, though.
They're up more than
11%,
almost 12%. There you go. Shares are up quite a bit on an upgrade from JMP Securities. We're going to talk to the analyst behind that call in today's Stock of the Hour. This is The Close on Bloomberg. We're keeping our eyes, no pun intended, on shares of Warby Parker. The stock is soaring almost 12% on the day after it was upgraded to outperform from perform at JMP Securities. Analyst Nick Jones says he thinks the consensus estimates for the eyewear maker's 2025 and 2026 top and bottom lines are too low. Nick joins us now for our Stock of the Hour. Nick, why is it that perhaps people don't appreciate the growth trajectory that you see?
Yeah, so what really happened was during the pandemic, there was really not a lot of places to spend your discretionary money. Warby Parker, like many online retailers, benefited from that, and it shows up in the data. There's a big pull forward in demand in 20 and 21, and on average, people upgrade their eyeglasses every about 2 years, give or take. So when we started looking at the data, we actually are starting to see a little bit of signs that this is starting to come back and that we're going to start potentially seeing an upgrade cycle. So what that means is that likely end of this year and into 25 and 26, we expect a little more spend on the category by consumers, particularly once we get past the election, because there is an impact of the election kind of taking mind share from consumers spending money and really just kind of focusing on what's going on and what's setting up to be probably a contentious election cycle. So one, we think top line estimates are likely a little too low. Where we really think the street was kind of out of bounds was on the profitability profile. We started looking at estimates on, some of my peers, and they look too low on the bottom line. They have a really successful footprint of retail stores that deliver 35% plus EBITDA margins on average. And we started to consider that in their corporate overhead. We started to believe the margin expansion story was underappreciated. They have a really strong playbook. As they roll it out, we think a lot of this incremental revenue is going to flow to the bottom line.
But everything is so cheap. I don't understand how they can actually improve their margin profile, plus their top line with more revenue. Like, what's going to be, what's the magic moment for them?
Well, so a misconception in eyewear is that it's expensive. And a lot of that's because you're buying luxury brands that are essentially using cheap manufacturing and you're paying for the brand. Warby Parker knows this, and they come in with their entry price point of $99, and it goes up from there depending if you have progressives and they have some higher cost frames. But ultimately, to make glasses is not really that expensive. They can deliver strong margins. Really, for Warby Parker is they have high corporate overhead costs, right? So they have support staff, they have headquarters. They're a growing company. They do not have to spend much more on the support staff or their corporate overhead, and any incremental revenue will essentially just drive revenue on this kind of set cost base today.
You talk about this upgrade cycle for glasses. We know consumers are being a lot more picky in their purchases. They're seeking value. They're deferring what doesn't need to be spent, the election perhaps being one of those occasions. Is Warby Parker a consumer staple or is it a consumer discretionary company? And I ask because, glasses are a staple, but a second or a third or fourth pair are not staples. And sunglasses are also not necessary in the same way. So how dependent is Warby Parker on must-have versus nice-to-have spending?
So it falls in between, right? So the second pair is definitely discretionary, but if your vision changes, for many folks like myself, it can every few years, then it becomes kind of a requirement if you get headaches or things like that. Or, I have a small kid, if he ends up stepping or breaking my glasses, then it becomes a staple immediately, right? But for many folks, a few years past, the various coatings on the glasses start to wear, the frames may break or get loose, and eventually, from just normal wear and tear, you do need to get a new pair of glasses. So It's a staple, but it has a little bit more of a discretionary timeline as to when you decide to upgrade. It falls in between.
So, Nick, in full disclosure, I did Warby Parker like back in the day, and it was like one style with like 17 colors, and I was like, forget it. I'm on their website now. They have a huge range now, and plus a price range. So is that also a strategy, right? Like come in for the $95, but ooh, look at this cool $200 one?
Yeah, I mean, they're essentially going to meet the customers where they want to be. They have really strong kind of acetate, kind of like these types of glasses that I'm wearing that people can purchase at the $99 entry point. They have more frames with metal. They have more complex frames. They have different types of lenses. I mean, they're essentially offering a wide spectrum of frames that will actually often be cheaper than what you can purchase with insurance, whether it's iMed or VisionWorks. You can buy glasses from them in cash less than what your insurance will often provide to you. So it's really about a consumer awareness play here that as they continue to grow, continue to get adoption, it'll become kind of a point solution for a lot of folks to go and be able to get themselves or their broader family glasses, particularly if you have young kids who may be a little reckless.
Right, or me, who's also reckless with my glasses. All right, Nick, hey, thanks. We appreciate it. Nick Jones, analyst at Citizens JMP Securities. I should point out we're about 15 minutes away from the closing bell. S&P is up 0.8%, and volume isn't terrible for a Summer Friday, Scarlett.
Well, you know, we had Jay Powell speaking at 10 a.m., and after he was done, people put in their trades, and they're like, that's it, until
we're
NVIDIA.
Here. And you know who's here? Kristina Hooper. She'll be joining us next, Chief Global Market Strategist at Invesco. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Alex Steele. The trajectory of equities is very clear. It was pretty much up since Jay Powell started speaking. You also have a rally in the bond market with yields moving lower. Obviously, the dollar is getting hit. But just take a look at sort of the broad-based rally. And, Scarlett, look at the Russell 2000 up by 3%, most definitely outperforming. And it's pretty much all of the sectors are higher, but particularly it's real estate, it's materials. It's going to be those cyclical stocks that are doing really well on this.
Yeah, biggest rally since mid-July for the Russell 2000. So we keep wondering whether the outperformance is going to last. So far, it is, as long as all indications are the Fed's going to cut. You also included NVIDIA, which is notable, of course, because next week that's the big seminal event, NVIDIA reporting earnings.
Right, and will it be a market event, or will it be an NVIDIA event? And then maybe like a Mag 7 or a semi event, or is it going to really wind up affecting the whole markets? I mean, I've talked to a lot of people who are actually not taking vacation anymore the last week in August because of NVIDIA, so I don't know how that's going to affect the movement in the market either.
Well, one person who's not taking vacation is Kristina Hooper. She is Chief Global Market Strategist at Invesco, and she joins us in studio. Thank you so much, Kristina.
It's great to be with you.
So Alex points out an important thing, which is, you know, NVIDIA's reporting results next week. Are people going to over-interpret the results, given that it's in the middle of summer, late summer, I should say, August, and, you know, we have the Fed out of the way, and, you know, this is the only catalyst for the week?
Well, NVIDIA definitely is important because it's been such a critical driver of S&P 500 returns. But I think we're already starting to have less reliance on NVIDIA earnings as we see a broadening in terms of more companies contributing to earnings growth going forward. So certainly it will have some impact, but I think far more important in coming weeks is going to be economic data. Because what we heard loud and clear today from Jay Powell was that he doesn't want to see any more deterioration in the labor market. And so anything that suggests there are more cracks in the economy is going to be very problematic for the stock market, in my opinion.
So he definitely said that, yes. There were other Fed officials, though, that kept talking about needing to see more data on inflation, and we're still worried about higher prices when it came to inflation. So is it that much of a done deal?
I think it is pretty much a done deal at this point. I can't see any kind of obstacle that comes in the way of the Fed cutting in September. Now, the key becomes, or the critical issue is, how much do they cut by? And I think it's very, very likely it's 25 basis points. Even if the Fed thinks it's behind the curve, what we saw in March of 2022 was that they started with a 25 basis point hike. 50 basis points might be an admission of guilt, that maybe there was a policy error. So I don't think we're going to see a 50 basis point cut. And I think that perhaps that moderating language from other FOMC members is telling us that.
So we're going to get an environment in which a decent jobs report that kind of confirms what the Fed has been saying, what Powell says, will be received positively. But if it deteriorates too much, it won't trigger a bad news is good news reaction.
That's correct. I think it's going to be bad news is bad.
We were talking to a guest earlier at the top of the hour, Earl Davis, and he was saying that he thinks it actually could be like a 25-50, 25-50, that there was a world where you would have that kind of a road for cuts. Do you think that that would happen? And if so, what does that do to the market?
I think there's certainly the possibility that after we start with 25, we could see an increase in the next cut. And maybe there is some kind of back and forth between 25 and 50, although that hasn't been recent history for the Fed. I suspect it would be more akin to what we saw during this most recent tightening cycle, where we could have some big months, and then, of course, a leveling off, so to speak, in terms of what we see towards the end of the rate cut cycle.
What do you think is going on with the dollar here? Because it's been sinking, and today it is lower versus all the 16 major currencies. Alex keeps talking about reading notes in which people are saying that the dollar is a new carry currency. It's a new carry trade. Is that what you're seeing? And is the expectation that the dollar is just going to continue sinking from here because of the Fed's road ahead?
I think that's right. I think what we are going to see is a continued weakening of USD. It was strong for a long time, and I think perhaps too strong, but it reflected expectations around monetary policy. Things have reversed very quickly. And I think that certainly some of the weak economic data we've seen recently has been part of the reason that we've seen a weakening dollar, and I think we're going to continue to see that.
So if I read between those lines, that means that the dollar is weakening because the economic data is weakening. The Fed will cut because the economic data is weakening, not cutting in a non-recessionary environment. Are those two different?
Well, I think two things can be true. I think that we're in a non-recessionary environment and monetary policy is too restrictive based on how much disinflationary progress we've made. But we have that additional rationale that the economy is showing signs of weakening, and that should encourage the Fed, or could cause the Fed, to cut more, and that's the result, that weakening dollar.
Does that change, though, the leadership in the market?
So I think for now, what we're anticipating, our base case, is that we see a slowdown, but it's rather brief, and then we see an economic reacceleration. So that would suggest that the rotation, the outperformance by small caps and cyclicals continues. But that's a big if, because every day that rates are at these levels, very restrictive, is a day in which recession risks grow. And so we've got to watch the data very closely, and I think there's certainly a chance that if the data is worse than we anticipated, that we could see an end to outperformance by small caps and cyclicals. Not my base case, but certainly something I'm watching carefully.
Okay, so again, if bad news ends up being bad news as interpreted by the market, the small caps are going to be the ones that feel it first.
Absolutely. Small caps and cyclicals.
Okay.
No, go ahead.
I want to ask you about what's going on in Japan, because the new Bank of Japan governor, not so new, but newish, Kazuo Ueda, spoke yesterday before Parliament. And that was seen as maybe something that could be market moving, given that the BOJ rate hike was kind of one of the things that sparked the market meltdown at the end of July and culminated in the big sell-off on August 5th. Going forward, how much of a risk is the Bank of Japan and what it does to the global market stability?
So I think the Bank of Japan is very well aware of its power with markets. And so I think that makes it less of a risk. I've felt that the kind of proactiveness we've seen on the part of policymakers in general in this monetary policy environment has been a positive in that they look very quick to act. And the fact that we saw the BOJ come out so quickly and reassure markets and say, hey, we're not going to do anything more if there's instability, I think suggests to me, and of course, speaking to the diet, all those things to me means this is a Bank of Japan that's very wary and understanding of its power and will proceed cautiously.
Yeah, and will be quick to soothe if needed.
Absolutely.
All right, Kristina Hooper, Chief Global Market Strategist at Invesco, thank you so much for joining us. We are looking at this rally holding forth, and I was just checking volume to see if it, really tapered down. Didn't necessarily.
No, it didn't. I mean, it's not. I mean, it's still a little bit lighter versus the 10-day average, but it's not terrible. So people are clearly still here. in essence in the market as you look at lower yields, buy equities, sell dollar. Like that really is the setup in the trade as we head into next week.
All right, we're moving you closer to the closing bell on this Friday. We've got full market coverage right here on Bloomberg Television, Bloomberg Radio, across all of our platforms.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day and week. Scarlett Fu and Alex Steele here. And to take us through the closing bell, we've got a global simulcast. Let's bring in now Carol Massar. No, it's just mentioned.
Surprise.
And Tim Stenovich. And of course, welcome to all of our audiences across Bloomberg Television, Bloomberg Radio, and YouTube audiences. Tim, let me start with you because I look at the major indexes right now, all up at least 1%. The Russell 2000 really stands out with that 3% gain because Jay Powell has moved forth with declaring, as much as he can declare, I guess, that there will be a rate cut in September.
You know what's so surprising to me is seeing the move in small caps because I thought this was priced in. I thought everybody was expecting him to say something like he said today. Did you guys hear any surprises today? I mean, the time has come is sort of the phrase of the moment, but it doesn't seem like, it seems like a lot of investors knew this was coming, yet the market hadn't completely priced it in.
Well, I think what was the surprise there was, especially Bill Dudley had talked about this in an opinion column for Bloomberg earlier, actually last week, and of course former, when you're thinking about the New York Fed there, but he was thinking that the Fed chair wouldn't be as specific and signal as much as he did, and so that's what markets weren't expecting.
Well, I also think that the we don't seek or welcome further labor market cooling was pretty clear. It was like our reaction function will be to the labor market, and if it gets worse, we're going to be cutting ASAP. Like that seemed to be sort of a mover there for me.
So what that means for markets is that everyone is now fixated on 2 Fridays from now when the jobs report comes out. And what do you do until then?
We call out that day.
Well, we just spoke to Louis Navalier, who said he's advising clients to just chill until Labor Day.
Also, NVIDIA earnings next week.
That's a long time, guys.
Yeah, it's definitely a long time. All right, there we go. Our scores are settling here for the day on this Friday. We're looking at an S&P closing up. We're settling out, but up by about 1.1%. So we are right around the highs of the session here. We're also looking at the NASDAQ up by 1.5%. The Dow Jones Industrial Average up 1.1%. So we definitely rallied into the close here.
All right, well, taking a look at under the hood of the S&P 500, we did see the vast majority of stocks move higher today. 434 names in the index moved higher. 68 moved lower.
Yeah, it's a pretty broad advance here, and I'm looking at the 11 sector groups, even the 24 industry groups. And look at that, everyone. It's a pesto pie or spinach pie, however you want to look at it. The only
little
sliver,
tomato there.
I know. The only sliver of red there is in household and personal products, and a little bit of maybe software and services, but you're talking about a lot of green there. It's led by, the gains are, that is, real estate investment trust up 2%, consumer discretionary, and tech all gaining at least 1.6%.
Okay, well, you heard Jess say the name NVIDIA because I've got my eye on what happened with NVIDIA today, the best performing stock in the S&P 500 on a points basis today, higher by 4.5%. Keeping an eye on the stock because Wednesday after bell, the company reports earnings. We did have Esha Day on our program a little earlier. She said, she reminded us there could be big implications, of course, for the market, given that it's the second heaviest stock in the S&P 500. It's outsized weighting, of course, and it could move 9% in either direction following the report. That's at least according to Citigroup's equity trading desk. Also, keeping an eye on shares of Workday. They moved higher on the day today. They rallied after the company said it would increase profitability over the next 3 years to enable strategic investments, 12.5% to the upside for Workday. The company CEO said it'll save money in part by being selective in hiring and using AI in its call centers and finance departments. Finally, shares of the fast casual chain Cava surging today. The company raised its full year outlook. It posted second quarter results that beat the average analyst estimates. The latest indication that diners see good value in fast casual restaurant shares surging today. What is that, guys? Is that close to 20% higher?
It's close to 20%,
yeah.
Day? Wow. Really?
Huge.
Yeah, okay. That's a lot of, steak bowl? Is that what it is?
Yeah, it's all the things.
Okay.
We talked to the CEO, and he was basically, I'm taking market share from everybody. I mean, I'm summing that up, but yeah.
You tell him to open one near our office because there isn't one yet?
It's kind of close.
Okay.
You can order in,
They are expanding. They are expanding.
Yeah.
All right, thanks.
All right, guys, I'll take the decliners. Since I'm wearing red here, I'm going to start off with Intuit. It's obviously, we know it's a tax preparation software company. So if you look at this stock down almost 7%, its worst day since May 24th. Its latest results actually did beat expectations, though the problem here was that it gave a full year outlook that was strong as viewed, though executives do recalibrate here long-term growth expectations. So that's thought to weigh on the stock moving forward here. Another one I'm looking at, Las Vegas Sands down about 1%, worst day since August 14th. What happened here was UBS actually cut the recommendation on the casino operator to neutral. So they did say that the slow recovery and the company's Macau business was what was bringing that down. And then, of course, lastly, Red Robin. So this is a gourmet burgers here, American restaurant chain, down about 8.3%, worst day since August 9th here. So when you're looking at this, it's EBITDA guidance for the full year missed expectations. This does have a market cap less than $1 billion, and this stock's down actually roughly 65% year to date, guys.
All right, I'm taking a look at the bond market. No surprise, it was a rally across the board. The biggest move really came in the front end. You had yields closing down by about 9 basis points. In the 10-year, you had yields down by about 5 basis points. So you continue to have that bull move into the market, right? If you expect the Fed to go, you're going to see a lot of buying coming into the front end as we're anticipating those lower rates. Now, interestingly enough, usually you might wind up seeing the back end move a little bit differently if you're really worried about growth. But clearly the market seems to have a little more confidence in those rate cuts coming and then helping any sort of growth issues there. And then we're just waiting, guys. We're just going to wait till jobs. I mean, Jay Powell really set us up for that's going to be the reaction function for them. It's going to be the reaction function then for the market. I appreciate NVIDIA's here next week. Jess won't be here for that, but she promises to be covering it from Europe for us.
That's
right.
Really?
I am.
Really.
I'm going on vacation. Not sure where yet, guys, but somewhere in Europe.
Jess is what you call a last-minute planner.
Yeah, I'm just going to book something tomorrow and hop on a plane.
But she said she's still going to be like tuned into email and stuff for NVIDIA.
Of course.
Earnings.
We don't want to miss these NVIDIA results. Come on,
Okay,
guys.
that happens on the 28th. We'll bring you those numbers, of course, as soon as we get them. We're also getting inflation data in the coming weeks. Alex, as you mentioned, the jobs report is one to watch. That September Fed meeting happening in the middle part of the month. There's a lot happening in the next few weeks that we're, of course, going to keep an eye on. Also, we're keeping an eye on everything happening out there in Jackson Hole, Wyoming, where we did hear from Federal Reserve Chair Jay Powell a little earlier in the day. We do want to take you back there now, though, because standing by in Jackson Hole, Wyoming, is Michael McKee. It is going to do it for our cross-platform coverage of the market close on Bloomberg TV and radio. Let's take you back to Jackson Hole, though, where we find Michael McKee, international economics and policy correspondent. He's with Esther George, former president and CEO of the Federal Reserve Bank of Kansas City.
Well, thank you very much. And we do have Esther George with us. I guess we'd call you the Kansas City Fed President Emeritus now. But you spent many years, obviously, on the Fed, and you were known as one of the hawks of the Fed board. With Jay Powell's announcement today, are you, as a hawk, satisfied?
So I think the Federal Reserve has been talking for a long time about when is the right point to pivot. And, of course, we heard the chairman say today that point has arrived. And so I expect by September they'll be doing that. I'm not sure I disagree with that. I mean, I think as we look at inflation coming down, the issue was never waiting to get to 2%, but was figuring out the right time when you had a sense that it would sustainably be going back there. So I think starting in September might be a reasonable move.
Austin Goolsbee was with us a little earlier, the Chicago Federal Reserve president. He thinks policy is still pretty tight. Do you think it's tight, or is it sort of affecting the economy slightly? I mean, how much is the Fed affecting things now?
Yeah, you know, was a rapid rise in interest rates that has then been accompanied by an economy that has done pretty well. It's moderated for sure. We've seen that in labor markets. We've seen that in various measures of demand. But I think it would be hard to say this policy is too restrictive or too tight, because you have continued to see consumer spending hold up. You've seen growth hold up. The labor market remains, again, while softening, I think has done pretty well. So that will be the challenge for the FOMC, is to really gauge how far are they from an equilibrium as they go forward.
How far do you think they might be from? Do we have a good idea of what a neutral rate is?
You know, what's been challenging, I think, for me during this time is the characteristics of that shock. And so it was a supply side issue accompanied by strong demand factors coming in there when those hit at the same time. So as we look to see how things are beginning to moderate, it does raise the question about, are we going back to something that would be a very low rate, or has the world changed? And I think there are probably reasons to think there have been some changes that could keep rates higher. Not as high as they are right now, but certainly I don't think going back to maybe where we were.
What would you want the policy to be in terms of the pace of rate reductions, the size of individual rate reductions?
Well, I think it's a good idea to start in a gradual pace, because I think to do otherwise suggests that there is some urgency, that there's a problem, and it could in fact be that this committee will run into something that says it's time to go faster. I think for now, while they watch to see how inflation continues that downward drift, while they watch to see how the labor market does, it makes sense to move carefully, move slowly as they back away from the current rates.
What about the pace? Would you want, do you think that the conditions justify a move at every meeting, or should they skip meetings to see what's happening in the economy? How would you time it out?
Well, I think they're going to have to, again, as everyone says, they're going to get more data between now and the time of their meeting. And I think as they put all that together, judging whether they feel like they need to make a series of moves, and that might make sense to do that. One move and then stopping probably isn't going to tell you much. So just as they had to move quickly with rate hikes, I think they could go slower, but they may have to continue a pace and then pause at some point after they've done a few of those.
Well, you're still active in the Kansas City business community. What do you hear from people there? Are they, the companies, they're optimistic about what's going on right now? Are they pessimistic? Are they somewhat neutral?
Yeah, I think businesses have been by and large optimistic. In fact, many of the surveys that I continue to watch from the Kansas City Fed that do a 6-month outlook continue to show optimism there. So while they're not having the same kind of troubles hiring, they also haven't had to lay people off, and their sales have been good so far. So I don't think those are the nature of their concerns right now. I think
so
they feel pretty good.
They're not thinking they might have to lay people off. They're not preparing for it.
I don't hear any of that. I don't hear any.
Well, now that you're no longer a central banker, you're an average American in the middle of the country. What do you hear from average Americans about how monetary policy is affecting them and about how the overall economy, how they feel about it?
Well, things that won't surprise you, Mike. People worry when they're trying to buy a house that the mortgage rate is high, the prices are high, and that complicates things. I still hear a lot of concern about inflation. And remember, for the average person, the inflation issue is not the rate of change that central bankers are looking at. For them, it is the level of prices and watching to see how something is so much more expensive today than it was. And that, of course, feeds into their dissatisfaction about the economy.
One last question, and that's basically about the balance sheet. The Fed had always said that it would stop QT before it cut rates, and now it's going to do both at the same time. Is that going to cause a problem?
Well, we'll see. I think what the committee needs to stick to is the plan they laid out. And the plan was we will get that balance sheet down to a smaller level. We'll continue to make changes to that. So they've already slowed the pace of QT, and I think, again, this will be another aspect of policy that they'll have to monitor as they go forward.
Well, thank you for your thoughts on this. Esther George, the former president of the Federal Reserve Bank of Kansas City. We'll send it back to you. Looks like it might rain here, so we're going to go inside.
Perfect timing. Michael McKee speaking with the former Kansas City Fed president, Esther George. And, I mean, they've had remarkable weather out there, so
I know. I mean, he can handle some rain. Let's be honest. He's got a cowboy hat, cowboy boots. I don't feel sorry for him. But I thought that Esther George, the notable hawk, was talking about, September, that you didn't disagree. I thought it was interesting that, you could get some cuts and then pause, see how it goes. So more of a different approach to a cycle.
That would blow the minds of so many people who are expecting once this rate cut goes into effect, that's it. We're going all the way back down to what it was.
Yeah, exactly. So we'll have to see how the market reacts to something along those lines if that winds up playing out.
All right. Well, coming up, we've got instant coffee mania. A once snubbed bean variety is now back in the spotlight as prices brew their way to record highs. It's commodities, Alex.
Coffee.
Yay.
Coffee.
This is The Close. I'm Bloomberg. Welcome back to The Close. I'm Scarlett Fu.
And I'm Alex Steele. Let's take a look at where markets closed for the day and the week. So it was a very playbook move. You bought equities, you bought bonds, and you sold the dollar. That's really what transpired after Jay Powell spoke throughout the day. Equities were trying to find their footing after that, but they continued to rally, now closing around the highs of the session. Obviously, tech following suit. NVIDIA also finding its footing. And just take a look at that front end of the bond market. You have yields down by about 9 basis points. But the dollar, quite significant.
Yeah.
Bloomberg Dollar Index down by 1%. It's now 5 straight weeks of losses. We haven't seen that, I think, since about April of 2023. So the losing streak is definitely there.
And the Fed hasn't even begun to cut rates yet. Let's just remind everyone. So that's remarkable.
And is it carry? Is it interest rate differentials really playing out? Is it a signal of a recessionary environment? All those questions still in the FX market.
Or the anticipation of those things. And let's just see if that actually plays out, right? Well, Jay Powell said the time has come for the Fed to cut interest rates. And so most stocks did gain in the S&P 500. It was a little bit hard to find decliners. So I stuck with all advancers. Let's start with Cava Group. Reported earnings, a beat and raise quarter, and the stock at a record high, taking market share from fast food chains who've raised their prices faster than other kinds of restaurants, as well as high-end restaurants, because consumers are seeking more value and they're trading down. So the company also saying it's accelerating its store openings plan. I know Alex is looking forward to maybe something being really close to the office.
Yeah, that'd be fun, right?
Right?
Mm-hmm.
Yes. Workday climbing about 12.5%. The software company said it would increase profitability over the next 3 years to enable strategic investments. The second quarter results also beat estimates, and its operating margin improved. And you mentioned NVIDIA. That is the next big event for the market when it reports second quarter results on Wednesday. What analysts are looking for right now is a doubling in sales and EPS for a fifth straight quarter. Pretty remarkable numbers. You would think at some point there would be difficult comps, but not yet.
No, definitely not yet. So one area of the market that I'm obviously always paying attention to is what's happening with commodities.
Really?
And, shocker. I know. I realize this. And if you take a look at coffee prices, so Arabica beans are fancy pants beans, and those prices are up 54% in the last year. But Robusta beans, and that's the instant coffee beans, they're up 92%. Now, apparently, the popularity is really heating up for those Robusta beans. It's now at an all-time high. The double shot to consumers. You got droughts in the beans' top producer in Vietnam, so that's a supply issue, and that raises prices even more. But there also is demand for instant coffee. Ugh. All right, here, Spill the Beans with us is Bloomberg's Ilena Peng joining us. So usually, if you get this kind of rally in any commodity, you just find substitutions, right? Like you just go buy Arabica beans instead of Robusta. Why is that not happening this time?
It's because we're drinking more instant coffee than ever.
So really, we like it.
Yeah, people like it. Instant coffee has been rising for years now, and I think the pandemic really bolstered that. People went home and people decided this was a convenient, fast way to make coffee around the world. And so that's really stuck around in a way that hasn't been the case in the past. So even though with prices as high as they are now, you would expect Arabica demand to be rising and Robusta to weaken a little bit. And we are seeing that, but analysts are saying it's really not as much as they expected, and definitely not enough to cool prices.
So you called Arabica fancy pants beans?
Yeah, okay. Sorry, that just came out.
So Robusta has been considered like the cheaper alternative, but perceptions of that are changing as well in a more structural way.
Yeah, so they have long been considered the cheaper bean. They're a little bit more bitter is basically the gist of it, I think. But a lot of the companies I've spoken to seem to think that with more investment, Robusta can really be the same quality as Arabica. And because it's a little, because it's a little bit more climate resilient as well, they're hoping that, if they apply the same Arabica growing procedures like hand picking coffee cherries, then eventually the Robusta will have better flavor and then be a better long-lasting alternative to Arabica once that gets harder to grow.
Yeah, so it's like a Starbucks is going to buy Arabica beans. So
they'll never use Robusta?
No. They're Arabica.
Yeah. Everyone's like, no.
Like source their supply versus like Folgers, which would use the instant coffee. Do we know why the demand for instant coffee and Robusta beans is growing so much?
I think a lot of it is convenience. I think part of it is also we're seeing a lot more cold drinks. Yeah, a lot of canned coffee. And so sometimes those use blends of Robusta and Arabica. Espresso blends also like to use Robusta because they get more of that nice foam on top of the drink.
Yeah,
iced coffee changes everything.
That's really interesting.
Yeah,
well, and also because Arabica beans aren't all made equal either, right? There's different layers of this premium and then maybe not as fancy pants Arabica beans, and that's where you might see some substitution. But it's just so interesting that you're not winding up seeing that this time.
Yeah, absolutely not seeing that as much. So both with Arabica and Robusta, there are different grades of beans. And so I think it's a really interesting shakeup in the coffee market now because we see super high-end Robusta is actually more pricey than Arabica in some cases. We talk to some roasters that buy from Vietnam, super high-quality specialty Robusta, and they're paying more for Robusta than Arabica, and that's something that's sort of unprecedented for coffee.
Big shift in the coffee bean market. Really, really fascinating to get your take. Ilena Peng joining us here. She covers the soft commodity space, which includes coffee beans, fancy pants coffee beans, and less fancy pants.
Wow, she's going to say this forever now.
I know, that's how I'm going to remember. Arabica, fancy pants. Coming up, we've got the top three, where we focus in on the top three movers and shakers at the center and at the center of the week's big stories, not just day's big stories. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Bennifer. It's been quite a week for the pair because J.Lo filed for divorce from Ben Affleck, and by most accounts, there was no prenup. So they'll need to split up their assets, Alex. And that starts with their 38,000 square foot Beverly Hills home called Crestview Manor, which is currently listed for $68 million.
But aren't taxes like $400,000? Like, the maintenance for this place is insane. I mean, I know this is not we're not the buyers for this kind of property, but also, right, for California, whatever you make when you're together, then you have to split evenly. Is that part of the rule?
After you've been married for 10 years. They've not been married for 10 years, and they each have their own fortunes. So it'll probably be a clean break. And I think she did file something about not having alimony or palimony being paid here in this case. But yeah, $400,000 a year plus in property taxes. Electric bill would be up to $10,000 a month. I know.
Oh,
it could be. It could be. This is according to New York Post.
Okay. Well, that's fair enough. I mean, I was complaining about my $500 Con Ed bill during the heat of the summer. All right. Next up, we got John Gray, Blackstone's president and COO. He's kind of become an influencer for the C-suite business leaders. He's posting updates on social media like LinkedIn. They're doing he's like the cool nerdy dad is kind of how he's being taken on, his persona.
He's got dad energy for sure. And he tries to strike a balance between folksy and financial. So he's kind of like a younger Warren Buffett. I don't know. I just made that part up. But PR experts say he definitely has figured out the formula for these videos.
Well, yeah. And Christine Anderson, kudos to you, a global head of corporate affairs, definitely put that into place.
All right. And last up, we're watching RFK Jr., who has ended his long shot presidential campaign. Let's take a listen to what he said.
And these are the principal causes that persuaded me to leave the Democratic Party and run as an independent, and now to throw my support to President Trump.
Throwing his support behind Donald Trump, and also very tan, but I was never really sure what his platform was.
I mean, depends on who you ask, I think. Many would say anti-vaxxer. He would definitely not say that. He would say he was not an anti-vaxxer, so it definitely becomes a little bit complicated. Pro-crypto, right?
Yeah.
That was one.
But beyond that?
Beyond that, I got nothing for you.
All right.
All right. Speaking of politics, you got the DNC in the rearview mirror. So questions are arising about what it was he actually learned about Vice President Kamala Harris's plans for the economy. It is the Bloomberg's big take. So we want to bring in Bloomberg's Amanda Gordon to break down what she saw in terms of policy outlines over the last few days. We got the vibes. Some say we got the joy, but the actual concrete plans is what Wall Street and CEOs are looking for. What do we know?
Well, the speech last night from Kamala Harris was light on content. And on some level, we can expect that. This is a political strategy. She issued some details a few days before the convention began, and they were immediately attacked by Trump and others on social media. Whereas at this convention, they brought in all these social media content creators to bring out that positive message. She spoke in her address about issues that pertain to the middle class, issues that pertain to those swing voters in battleground states that she really needs to win. And while there were people present from Wall Street and corporate America, like John Gray, in the arena that night, the fact is that those discussions are going to be on the sidelines right now, not her main message.
So for the business leaders who were there, what did they have to say about this content light policy message or speech overall? Does it bother them, or can they work with that?
Well, obviously, it's self-selecting group, correct? So
Fair.
I think there are probably people sitting in New York or San Francisco who are antsy about some of these details. The people in these rooms have a comfort level. They talked about knowing her, having worked with her on her 2019 campaign for president. And some people in New York that I spoke to said that they know these very advisors of hers, people like Ray McGuire, who ran for mayor, Blair Efron, who runs Centerview. And these are people in the mix, and they have a pretty broad profile. So the main message that I heard is that these concerns about regulation, some of the sort of more pro-labor and anti-business policies that we've heard, there's going to be a re-listen and a re-hearing out and working through how to deal with these things, and there will be more openness.
Amanda, really appreciate your joining us. I know it's a late night for you and the Bloomberg News crew in Chicago attending the DNC. Bloomberg's Amanda Gordon in Chicago. Coming up, the first VC fund ever to focus on helping the disabled. This is Bloomberg. Venture capital funds, they tend to focus on certain kinds of startups, maybe AI or crypto or sustainability. But what about a fund dedicated to closing the disability wealth gap? Enable Ventures is the first impact VC to do just that. In this week's Next Up segment, where we highlight the entrepreneurs and founders moving the needle for our economy, markets, and technology, we welcome Regina Kline. Gina is founder and managing partner of Enable Ventures. Gina, great to see you here.
Thank you so much for having me.
So how do different startups, because you do invest in startups, go about offering technology solutions to people's physical disabilities? Just walk us through that first.
Well, we exist in a very unique moment in the capital markets, and frankly, I would say in history. There's 1.5 billion people with disabilities on planet Earth today and growing. And never before have we had such self-identification of what disability is and what it means. And there's a reason for that. The history of civil rights is long and storied for disability, but there have only been rights since 1990, and that is consecutive with the same period of great technological revolution. And where we find ourselves today is with those 1.5 billion people with disabilities in urgent need of technology, with hunger for new and emerging technologies, and nearly $8 trillion of annual disposable income a year in their hands.
Those are some big numbers here, and one thing we should mention is a lot of disabilities are not visible to the naked eye. It's something that exists, but it may not be obvious. What's the common thread for the array of tech businesses that are actively trying to solve this?
What is in strong contrast in this market is that disability is not a horizontal, it is not a vertical, but it is a horizontal. And what I mean by that is that there are founders who are leveraging their lived experience or co-creating and co-designing with the organized disability community to develop solutions that are uplifting human potential, that are bringing about equity in work, education, skills training, access to assistive technologies, and they're in verticals that are emerging tech, AI, the bleeding edge of new technologies and sensors, neurotechnology, and so on and so forth. So what is very exciting in the markets right now is the type of founder that's leveraging these experiences to bring about their experiences into the technology, embedded into the technology that they're designing.
Can you get more specific and just give me an example of one of these companies and what they do?
Absolutely. So there's companies in our portfolio that are perfecting transcription technology using AI that are 99% accurate captioners for the deaf and hard of hearing population. And yet they are selling their product. The company is named Ava, is selling its product to enterprise customers like Nike and into higher education. And some of the feedback that the company is receiving is that it is perfecting transcription in a way that not only deaf and hard of hearing students and workers are benefiting, but so are people who are hearing end users who are getting a better note taker. And so what we see time and time again is when designers with disabilities are at the core of their companies and in product design, they design with everyone in mind and to reduce the exclusion of the product design.
Something you've noted is that investors in Silicon Valley and Wall Street have kind of overlooked the disability tech market. So where is the current funding coming from? For instance, who are your backers?
So we have partnerships with folks like United Healthcare, who really see a nexus between when people with disabilities in the world work, they have overall better long-term healthcare outcomes. And when they have better health care, they have more access to work. And what we are investing into in that thesis and our fund strategy and our partnerships is the idea that there are more and more tools that are coming into development right now as technology is definingly shifting towards AI and more affordable, accessible solutions. We are ready to see the next generation of people with disabilities with tools that were never dreamt of before, that they've built themselves for work, education, and skills training.
Gina, how did you first get involved in the disability tech market? What brought you in?
Before becoming an investor, I had spent a good many years as a civil rights attorney and disability rights lawyer, representing the interests and vindicating the civil rights of people with disabilities across the United States, including working at the Justice Department. What I have understood is that throughout my career, that people with disabilities who are closest to the barriers and the obstacles that they face are the very best designers in the world. And for the last 50 years of the technology market, many disability designs have made their way into the capital markets. The only thing conspicuously missing is dedicated venture capital to really effectuate keeping capital investment in the hands of people who are the designers.
All right, well, Enable Ventures is looking to change all of that. Gina, really appreciate your joining us today. Thank you so much.
Thank you for the privilege.
Gina Kline is founder and CEO of Enable Ventures. Let's just give you a recap of how things closed on the day when it comes to the equity market and the bond market. You have gains all around here with the S&P 500 up 1.2% on the day. The Russell 2000 flying high, gaining 3%. That was the biggest gain since mid-July. And the two-year yield falling below 4%. 3.90% as bonds rallied. And that, of course, is after Jay Powell made clear that the next move the Fed is going to make in September is going to be a rate cut. After that, who knows? But for now, we know that September will be a rate cut as seen by Jay Powell. Bloomberg Dollar Index shows a decline of 1% in the U.S. dollar, lower against all 16 major currencies. This is the close on Bloomberg. It is one of the market's most highly anticipated earnings reports. We're talking about NVIDIA's second quarter results, which will be published on Wednesday after the market close. Of course, we will bring you live coverage when it happens. Traders are braced for volatility already. Melissa Otto is the head of TMT research at S&P Global Visible Alpha, and she joins us now with more insight. Melissa, I don't think it's an overstatement to say that this is the event for next week that could really determine the trajectory of the markets overall for the entire week.
Thank you. Absolutely. NVIDIA earnings are going to have a lot of eyes on them. I think certainly as we look at the consensus numbers, they haven't really been moving too much since the last quarter. Currently, based on Visible Alpha consensus, $25 billion in data center revenues seems to be the number to meet or beat. And then looking ahead to guidance, $27.7 billion in those data center revenues are going to be some of the key numbers investors are going to be focused on.
And of course, everyone's looking for a beat and raise kind of quarter. Based on what we know about Jensen Huang, the CEO and co-founder of NVIDIA, does he tend to be conservative when giving guidance?
I think it really depends on, the trajectory of fundamentals within their business, how the supply and demand are going, and in terms of, where the actual pace of momentum is going in their business. I think one of the looming questions around NVIDIA right now is around the performance of Blackwell and how the timing and trajectory of that is going to really hit the numbers over the next couple of quarters and into the longer term outlook.
Right, Blackwell being the next generation chip that it's introducing. And of course, it has a lot of pricing power on that as well. I'm curious to get your take, because we introduced you by saying there's going to be a lot of volatility. We know that options traders are expecting big moves out of the stock one way or another. How much does the stock move affect perceptions of the company's fundamentals? Because there's no way that people can overlook, the seismic moves that you get in the stock before the earnings and after the earnings.
Absolutely. Yeah, it's definitely a wild one. There's an enormous amount of debate, in terms of the longer term outlook. We see in our consensus numbers that, there is significant debate about the earnings trajectory, 2-3 years out. So I think that's part of the reason that you see that volatility, is that there are significant bulls and bears on the stock. But I think, one thing I will say is that based on the current track record, Jensen Huang has continued to meet or beat expectations the past several quarters, which is, I think, continued to surprise investors.
Absolutely. And when I look at the analyst estimates, what we're anticipating now is a doubling in sales and EPS for a fifth straight quarter. At some point, difficult comps is going to slow that trajectory down, but we haven't seen that yet, have we?
We certainly have not. And, I ran all those numbers back in December, and Visible Alpha consensus upward revisions saw $150 billion of upward revisions. And I thought that was very significant and compelling. However, looking ahead, they've just continued to rise higher and climb to over 200 billion in upward revisions. So what is this cap on that is still a bit unclear. And cloud service providers are one of the main drivers of that, and they continue to invest in CapEx.
What will you be listening for from Jensen Huang when he does speak that sets the tone for the next earnings season? Because this past earnings season, big tech, they came through with their numbers, but not to the extent that people wanted, given how much money they had spent building out the AI businesses and their AI capabilities. Investors wanted more. So Jensen Huang kind of sets the table for what investors will look to expect from other companies.
Indeed, investors always want more. It's by nature. One of the things that, I would say there's two critical things that I'm looking at. One is the Blackwell outlook. What's the current status? What should we expect? And then the second thing is, just some commentary around enterprises and broader adoption. I think the market understands well that cloud service providers are investing significantly in the infrastructure. There's been innovation in the model. And I think what we want to see is, how are enterprises, how is their broader adoption and in terms of where generative AI is going to go. I think there's still a really open question about that. We haven't seen innovation there for the end user.
Well said. Melissa, really appreciate your joining us from Tokyo as well. Melissa Otto is head of TMT research at S&P Global Visible Alpha. All right, we're going to leave Tokyo and Silicon Valley behind, and we're going to take a broader look at the state of California, because Governor Gavin Newsom is weighing a funding cut for cities and counties that fail to use up their existing dollars to clear homeless encampments. And these cuts could begin as soon as next year. Let's bring in Bloomberg's Nadia Lopez for more. So Nadia, let me just understand what's happening correctly here. Newsom wants cities to clear out their homeless encampments, but some cities don't want to do that. So he's going to punish them by directing Sacramento to give them less money. Is that right?
It's not necessarily that they're going to be punished. He still wants cities to take initiatives to clear homeless encampments as swiftly as possible. He just wants cities and counties to make the most of the funds that they already have. And if he doesn't see them use them up by next year, he'll consider funding cuts in next year's budget. Now, the difference between some cities like San Francisco and Oakland and even Fresno in the Central Valley that have taken more stricter enforcement measures to clear encampments or even go as far to cite or jail people for sleeping outside, and counties and jurisdictions like Los Angeles, which take a care first approach, say they're not going to simply do that if people have nowhere else to go. So that's the biggest difference that we see right now.
Thank you for clarifying that. Which cities are, I don't know, I guess resisting what Newsom is pushing for? Which are more welcoming of his initiatives?
His comments were more recently directed at jurisdictions like counties. So Los Angeles County, the Board of Supervisors, basically said, we're going to stick to our approach and we're not going to follow this more tougher approach to sleeping encampments.
And why now? Why is he cracking down now? We know homelessness has been a perennial problem in California, in part because of the warm weather for decades, but certainly since Gavin Newsom was elected governor. What's accounting for the urgency at the moment?
It's very clear that the governor is really frustrated. Since he was elected, he's allocated $27 billion towards homelessness services, programs, affordable housing projects, and now he's increasingly shifting the blame on those jurisdictions that he's allocated those funds for and saying that we need to move faster as a state to alleviate this issue. And it's part of a broader push that he's really been employing lately to enforce tougher policies. So this follows, even last week when he announced a slew of new laws aimed at really combating the state's retail theft and other crime measures that he's taken. So this is part of a broader extension of that.
Okay. Yeah, it's part of, addressing some quality of life issues in California across the board. Nadia, sounds good. Thank you so much. Nadia Lopez of Bloomberg News joining us right there. Let's stay with cities and states and the institutions that are there, because colleges and universities are going big or they're going home. Yes, of course, in sports, but also in bonds. And this is our Muni moment, because according to Moody's, schools need to raise up to $950 billion over the next decade to maintain and upgrade campus facilities and infrastructure. These are capital improvements crucial in the race to lure the brightest and most promising students. Danielle Moran leads Muni Bonds coverage for Bloomberg News, and she joins us now. So Danielle, those are some big numbers I just mentioned. Put some context around that almost $1 trillion of funds that Moody's estimates colleges need.
Yes, they are very large numbers, and ones that frankly surprised me when I saw the report. Higher ed issuance is around $22 billion this year, which is on pace for a record, like the rest of the muni market. Issuers are coming back after taking 2 years off because of higher interest rates, and they're back in the market full force. But for context, issuance in the muni market, which encompasses everything from states and cities to school districts and the MTA, is around $350 billion to $400 billion a year. So that estimate that Moody's said for colleges and universities to be between $750 billion and $950 billion over a decade is pretty remarkable.
Yeah, it's eye-opening, and this is on top of colleges. I mean, I look at your coverage all the time. They've already sold tens of billions of dollars of debt this year already, and they're doing that to build new dorms or build new facilities, and we're talking about, a jump from there.
Exactly. The colleges are coming to market in waves. So you have Princeton, Harvard, Cornell, Texas A&M, Vanderbilt, Villanova. Those are all schools that have issued so far this year. Williams College just issued about $100 million of bonds for a new art museum and a recreation center. You have two schools in Pennsylvania, smaller colleges, Moravian and Muhlenberg, located just a couple miles from each other, that are both building new student centers. And the calculation here is that parents come to campus, they take tours with their kids, and they want to see fancy new beautiful buildings. And there's a real competition for students. And that's sort of what's at the crux of this, according to Moody's and according to bondholders, is you want to get the students on campus, you want the parents in most cases paying tuition, and to do that, you have to incentivize them.
And also the parents want to see that because they're paying upwards of $90,000 a year in tuition. So it kind of like feeds on itself. The elite schools, you mentioned this fierce competition for students. The elite schools will always be flooded with applicants no matter what. But most colleges are not in that category. And they face what you call a demographic cliff, in which there are going to be a lot fewer students applying to colleges fairly soon.
That's true. There's an estimate that the college-age population will peak in around 2025. And that will mean that there's a smaller pie of students going to schools. So yes, the Ivies, the flagship public schools will always have demand, and they just keep growing. And what investors and rating agencies say is that the bifurcation between them and between the smaller, the liberal arts, the schools with a lot less demand, a lot less name recognition, will continue to get weaker. And they are also trying to compete. So they're taking on debt, and they're taking on more obligations to just sort of stay afloat.
Okay, they're taking on more obligations to stay afloat, but if they can't get the students interested who are going to pay the full freight tuition, then they start to run into trouble and not be able to service their debt. And you have also been following the schools that can't do that, right? Can't service their debt. A number of schools have already defaulted on payments. Where do things stand in terms of those numbers?
Yes, it's getting increasingly more difficult for smaller, weaker private schools generally to just operate in general and to pay bondholders. So there was data out earlier this month from Municipal Markets Analytics that say 15 institutions have disclosed either technical or payment defaults this year. That is on pace to be a record. It's only 2 impairments shy of last year, which was the most since at least 2009. And you don't necessarily have to be actually impaired on your debt to be struggling. So some schools are asking bondholders to borrow against their mortgage. Other schools are missing debt service covenant ratios. Some are drawing from their endowments. A school in Virginia that we covered drew almost a third of its endowment to pay for campus projects that they hope will get students into the school.
And also some of these universities have hospitals and medical centers attached, which also create their own challenges too.
Yes, it's no secret that healthcare has had a really tough couple of years. And for institutions with large academic medical centers, it bleeds into that. So earlier this year, we saw some ratings actions for USC, for Emory University, because their healthcare systems were underperforming, which hit the college bond ratings.
Oh, interesting, because you're talking about 2 schools that would fit into that elite category that would have no problem attracting students and families who pay the full tuition.
Exactly.
Danielle, thank you so much. As always, really appreciate it. Danielle Moran with today's Muni Moment. Still ahead, we've got what investors need to watch for next week. This is The Close on Bloomberg. U.S. stocks and bonds end the week with big gains after Jay Powell gave the clearest signal yet that the Fed will proceed with rate cuts soon. So let's take a look at what's coming up on the calendar for next week. On Monday, we get durable goods orders, not a tier 1 economic data point, but something to watch for nonetheless. We also have earnings from Trip.com. On Tuesday, NFL team owners will be meeting in Minneapolis to discuss and potentially vote on allowing institutional investors to buy into teams. We also have consumer confidence and earnings out of Nordstrom. So another read on the consumer. More consumer reads on Wednesday. Foot Locker, Chewy, Abercrombie & Fitch will be reporting. NVIDIA is the big earnings report on Wednesday. And then looking ahead to Thursday, jobless claims and pending home sales, all that coming up in the coming week. This is The Close on Bloomberg Television.